Stop right there. You are about to donate $2,100 of your hard-earned cash to the Australian Taxation Office as a voluntary tip. And the worst part is, you probably have no idea you are even doing it. If you are an Australian earning a high income and you haven't reviewed your private health cover and superannuation strategy in the last 90 days, you are walking straight into a financial ambush this June 30th. Welcome to Aussie Super Secrets. Today, we are exposing the exact legal loophole that high net worth individuals are using to shield $2,100 from the incoming Medicare Levy Surcharge. By the end of this video, I will reveal the one reporting error that causes the ATO to double dip into your retirement savings without you ever receiving a notification. You cannot afford to miss that. But before we break down the math of this $2,100 saving, we must address the legalities. This is general information only and does not constitute personal financial, taxation, or legal advice. You must speak with a licensed financial advisor or a qualified accountant before making any moves with your capital. Do you know what the most expensive mistake in the Australian tax system is? It is not the 45% top marginal rate. It is the cliff edge of the Medicare Levy Surcharge. For the 2025 to 2026 financial year, the Stage 3 tax reforms have shifted the goalposts. While your take-home pay might have increased due to the new 16% and 30% brackets, many Australians are now drifting into the higher surcharge tiers without realising it. If your household income is north of $194,000, or if you are a single professional earning over $97,000, the ATO expects you to have a specific level of private hospital cover. If you don't, they hit you with a surcharge of up to 1.5% on your entire taxable income. That is on top of the standard 2% Medicare levy that almost everyone pays. For a family earning $210,000, failing to manage this threshold results in a $2,100 penalty that provides you with zero benefit. It is literally a gift to the government. But what if I told you there is a way to legally manipulate your taxable income to drop below that threshold? This is where the $30,000 concessional contribution cap becomes your greatest weapon. Take the example of Sarah. Sarah is a senior executive earning $145,000 a year. She is currently in the 37% tax bracket. Without a strategy, her Medicare Levy surcharge could cost her over $1,400 because she opted out of private cover years ago. However, by using a catch-up contribution strategy, Sarah can use her unused caps from the last 5 years to tip an extra $20,000 into her industry fund, such as Australian Super or ART. This tactical movement does two things simultaneously. First, it generates an immediate tax deduction at her 37% marginal rate. Second, it lowers her income for surcharge purposes. In many cases, this single move pulls her below the ATO trigger point, completely wiping out that $1,400 surcharge. She has effectively paid herself instead of the taxman. But do you know the absolute worst thing the ATO can do to you if you get the timing wrong? We will see that in just a second. Because if you miss the deadline by even 1 hour, the entire strategy collapses. We need to talk about the BPAY death trap. This is where thousands of wealthy Australians lose their deductions every single year. Most people wait until the last week of June to make their voluntary contributions. They think as long as the money leaves their bank account by June 30th, they are safe. Wrong. The ATO rules are crystal clear. The funds must be received by your super fund to count for the current financial year. Clearinghouses and BPAY transfers can take between 3 and 5 business days to process. If you send $30,000 on June 28th and it doesn't land in your funds account until July 2nd, you have lost that deduction for the year. You will be hit with the full tax bill on that $30,000 and you may have just triggered a Division 293 tax bill for the following year unintentionally. You must have your cash moving by June 15th to sleep soundly at night. Are you getting value out of this? If so, make sure you are subscribed to Aussie Super Secrets so you never miss these high-stakes updates. Now, let's look at the admin fee cap trap that is bleeding high balance members dry. If you have $300,000 or more in a MySuper or default investment option, you are likely paying a percentage-based administration fee. Many industry funds and retail funds have a hidden choice or member direct option where these fees are capped at a flat dollar amount. By simply switching your investment structure within the same fund, you could save $500 to $1,000 a year in fees alone. That is money that should be compounding in your balance, not paying for the fund's marketing budget. As we approach the business end of this strategy, remember again that this is general information only and does not constitute personal financial, taxation, or legal advice. Always verify your total superannuation balance, or TSB, via MyGov before making large contributions. The TSB is the gatekeeper of your wealth. If your balance was over $500,000 on June 30th of last year, you are prohibited from using the 5-year carry-forward rules. I have seen high flyers tip $50,000 into their fund thinking they were being clever, only to be hit with excess contribution penalties because they didn't check their TSB first. The ATO does not play fair when it comes to these limits. But here is the climax. The secret interaction between the Medicare Levy and the Division 293 tax. For those earning over $250,000, the government hits you with an extra 15% tax on your super contributions. This is the Division 293 sting. When you combine this with the 1.5% Medicare Levy Surcharge and the standard 2% Levy, your effective tax rate on those last few dollars is astronomical. The legal loophole to saving that $2,100 lies in the family income calculation. The ATO allows you to aggregate your income with your spouse to determine the surcharge tiers. If one partner is a high earner and the other is not, you can use targeted super contributions for the high earner to drag the entire family's combined income below the surcharge threshold. You don't just save on your own tax, you save on your partner's surcharge liability as well. It is a double win that most retail funds never bother to explain to their members. If this revelation made you realize how much money you've been leaving on the table, you need to be ready for what's coming next. In our next episode, airing this Thursday at 7 p.m., we are going to expose the 3 industry funds that failed the latest performance test, and why your money might be at risk if you don't move it before the new financial year begins. Don't let the ATO dictate your retirement lifestyle. Take control of your super and keep your wealth where it belongs. Subscribe to Aussie Super Secrets now, and I will see you in the next one. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. Copyright symbol 2026 Aussie Super Secrets. All rights reserved.